Introduction. Value investing is an investment strategy that has been around for decades and has been championed by some of the most successful investors in history. At its core, value investing is about finding undervalued companies that have strong fundamentals and holding them for the long term. While value investing can be a challenging and sometimes complex approach, it offers investors the potential for solid returns and the opportunity to build wealth over time. This book is designed to provide a comprehensive guide to value investing, covering everything from the fundamentals of financial analysis to the psychology of investing and the importance of patience. Whether you're a seasoned investor or just starting out, this book will help you understand the principles of value investing and how to apply them in your own investment strategy. Throughout this book, we'll cover the different types of financial statements and ratios that investors use to evaluate companies, the various valuation methods that are commonly used, and the importance of factors such as margin of safety, competitive advantage, and management. We'll also explore some of the common mistakes that investors make when practicing value investing and how to avoid them. In addition, we'll look at some of the challenges and opportunities of value investing in today's fast-paced, technology-driven markets. We'll discuss the impact of market cycles and the importance of diversification, as well as the ethical and social considerations that are increasingly important to investors. By the end of this book, you should have a solid understanding of what value investing is and how to apply its principles to your own investment strategy. You'll have the tools and knowledge you need to identify undervalued companies and build a diversified portfolio that can help you achieve your long-term financial goals. So, let's dive in and explore the world of value investing. What value investing is. Value investing is an investment strategy that involves buying stocks that are trading below their intrinsic value. Intrinsic value is a company's true underlying value based on its financial performance, assets, and future growth potential. A company's stock price may not always reflect its intrinsic value due to a variety of factors such as market conditions, investor sentiment, or external events. Value investors seek to identify these discrepancies between a company's stock price and its intrinsic value and invest in companies that they believe are undervalued by the market. The goal is to buy these undervalued stocks at a discount and hold on to them until the market recognizes their true worth, generating a profit. Value investors typically focus on fundamental analysis, which involves evaluating a company's financial statements and other data to determine its intrinsic value. This may involve examining metrics such as earnings, revenue, book value, and cash flow, as well as considering qualitative factors such as the quality of the company's management, competitive advantage, and future growth prospects. Value investing also emphasizes the importance of a margin of safety. This means that value investors look for stocks that are trading at a significant discount to their intrinsic value, providing a buffer in case of unexpected market events or company-specific issues. Value investing is often associated with famous investors such as Benjamin Graham and Warren Buffett, who have demonstrated the success of this approach over the long term. While value investing can be a challenging and sometimes complex strategy, it offers the potential for solid returns and the opportunity to build wealth over time. The history of value investing and its most notable practitioners. Value investing has a rich history, with roots dating back to the early 20th century. The father of value investing is widely considered to be Benjamin Graham, an American economist and investor who taught at Columbia Business School and authored the seminal book, The Intelligent Investor, in 1949. Graham's approach emphasized the importance of fundamental analysis and a margin of safety, and his ideas have influenced generations of investors. One of Graham's most famous disciples was Warren Buffett, who went on to become one of the most successful investors in history. Buffett's investment firm, Berkshire Hathaway, has generated remarkable returns over the decades by investing in undervalued companies and holding on to them for the long term. Buffett is known for his focus on the intrinsic value of companies and his willingness to pass on investments that don't meet his high standards. Another notable practitioner of value investing is Seth Klarman, founder of the Baupost Group. Klarman is a disciple of Graham and Buffett and has been recognized as one of the most successful investors of his generation. He has built his fortune by investing in distressed assets, undervalued stocks, and other opportunities that he believes are mispriced by the market. Other notable value investors include Joel Greenblatt, founder of Gotham Capital, and Charles Munger, vice chairman of Berkshire Hathaway. Both have achieved remarkable success by applying value investing principles in their own unique ways. Overall, the history of value investing is marked by a commitment to disciplined analysis, a focus on long-term investing, and a willingness to go against the crowd when necessary. While the specific methods and techniques used by value investors may vary, the underlying principles of seeking out undervalued assets and patiently waiting for the market to recognize their true worth have stood the test of time. The benefits of value investing. Value investing offers a number of benefits to investors who are willing to take a disciplined, long-term approach to their investments. Some of the key benefits of value investing include: 1. Potential for strong returns. Value investors seek out undervalued companies that they believe have strong fundamentals and good long-term growth prospects. By buying these stocks at a discount to their intrinsic value, investors can potentially generate significant returns over time. 2. Margin of safety. Value investors place a strong emphasis on a margin of safety, which means they look for stocks that are trading at a significant discount to their intrinsic value. This provides a buffer in case of unexpected market events or company-specific issues, which can help protect investors from losses. 3. Long-term focus. Value investing is a long-term strategy that emphasizes holding on to investments for the long term, rather than trying to make quick gains through market timing or speculation. This approach can help investors avoid the pitfalls of short-term thinking and volatility. 4. Fundamental analysis. Value investors typically use fundamental analysis to evaluate companies, which involves examining financial statements and other data to determine a company's true underlying value. This approach can help investors avoid the hype and speculation that often drive short-term market movements. 5. Discipline and patience. Value investing requires discipline and patience, as investors may need to wait for the market to recognize the true value of a stock. However, this approach can help investors avoid the emotional highs and lows that often come with short-term trading and speculation. 6. Diversification. Value investing also emphasizes the importance of diversification, or spreading investments across different asset classes and sectors. By diversifying their portfolios, investors can reduce their exposure to risk and potentially improve their overall returns. Overall, value investing offers a disciplined, long-term approach to investing that can help investors achieve their financial goals while minimizing risk. While value investing requires patience and discipline, investors who are willing to stick with this approach over the long term may be able to generate significant returns and build wealth over time. Chapter 1. What is value investing? Chapter 1 of this book will delve into the fundamental question of what value investing is and how it works. In this chapter, we will explore the basic principles of value investing, including the importance of intrinsic value, the concept of a margin of safety, and the role of fundamental analysis in identifying undervalued assets. Value investing has a long and storied history, with roots dating back to the early 20th century. The approach was popularized by legendary investor Benjamin Graham, who believed in the importance of buying stocks that were trading below their intrinsic value. Graham's disciple, Warren Buffett, went on to become one of the most successful investors in history, further cementing the importance of value investing as a strategy for building wealth over the long term. In this chapter, we will explore the key principles that underpin value investing, including the importance of a disciplined, long-term approach, the use of fundamental analysis to identify undervalued assets, and the emphasis on a margin of safety to protect against market volatility. Whether you are an experienced investor or just starting out, understanding the basics of value investing is crucial to building a successful investment portfolio. So, Let's dive into the first chapter and explore the question of what value investing is and how it can help you achieve your financial goals. Concept of value investing and its principles. Value investing is an investment strategy that involves identifying stocks that are undervalued by the market, with the goal of buying them at a discount and holding them for the long term until their true value is recognized. At the heart of value investing is the concept of intrinsic value, which is the true underlying worth of a company based on its fundamental financial and operational metrics. Value investors believe that the market may sometimes misprice stocks, creating opportunities for investors to buy high-quality companies at a discount. In addition to intrinsic value, value investing is also based on several other key principles. 1. Margin of safety. Value investors seek to buy stocks with a margin of safety, which means that the stock is trading at a significant discount to its intrinsic value. This provides a buffer against unexpected market events or company-specific issues, which can help protect investors from losses. 2. Fundamental analysis. Value investors use fundamental analysis to evaluate companies, looking at factors such as earnings growth, cash flow, and debt levels to determine a company's true value. This approach helps value investors avoid the hype and speculation that often drive short-term market movements. 3. Long-term focus. Value investing is a long-term strategy that emphasizes holding onto investments for the long term, rather than trying to make quick gains through market timing or speculation. This approach can help investors avoid the pitfalls of short-term thinking and volatility. 4. Patience and discipline. Value investing requires patience and discipline, as investors may need to wait for the market to recognize the true value of a stock. However, this approach can help investors avoid the emotional highs and lows that often come with short-term trading and speculation. 5. Diversification. Value investors also emphasize the importance of diversification, or spreading investments across different asset classes and sectors. By diversifying their portfolios, investors can reduce their exposure to risk and potentially improve their overall returns. Overall, value investing is a disciplined, long-term approach to investing that emphasizes the importance of intrinsic value, a margin of safety, and fundamental analysis. By following these principles, value investors may be able to identify undervalued assets and generate significant returns over the long term while minimizing risk. The difference between value investing and other investment strategies. Value investing is just one of several investment strategies available to investors. Here are some key differences between value investing and other popular investment strategies. 1. Growth investing. Growth investing is an investment strategy that focuses on buying stocks in companies that are expected to grow quickly in the future. Unlike value investors, growth investors are less concerned with a company's current valuation and more focused on its growth potential. Growth investors are typically willing to pay a premium for companies with strong growth prospects, which can make these stocks more expensive than value stocks. 2. Index investing. Index investing is a passive investment strategy that involves buying a diversified portfolio of stocks that tracks a particular market index, such as the S&P 500. Unlike value investing, index investing does not involve fundamental analysis or stock picking. Instead, investors simply buy a low-cost index fund and hold it for the long term. This approach can be a good way to achieve broad market exposure and avoid the volatility of individual stocks, but it does not offer the potential for outperformance that value investing does. 3. Momentum investing. Momentum investing is an investment strategy that involves buying stocks that have recently performed well and selling those that have performed poorly. Unlike value investing, momentum investing does not consider a company's intrinsic value or fundamental metrics. Instead, it focuses on short-term price trends and momentum indicators. Momentum investing can be a high-risk strategy as it involves buying stocks that may be overvalued and selling those that may be undervalued. 4. Dividend investing. Dividend investing is an investment strategy that focuses on buying stocks that pay regular dividends to shareholders. Unlike value investing, dividend investing does not necessarily involve buying undervalued stocks. Instead, it focuses on companies that have a history of paying reliable dividends and may be able to provide investors with a steady stream of income over the long term. While each of these investment strategies has its own strengths and weaknesses, value investing stands out as a disciplined, long-term approach that emphasizes fundamental analysis and a margin of safety. By following these principles, value investors may be able to identify undervalued assets and generate significant returns over the long term while minimizing risk. Chapter 2: The Fundamentals of Value Investing. Welcome to Chapter 2 of our book on value investing. In this chapter, we will dive into the fundamentals of value investing and explore the key metrics and principles that value investors use to identify undervalued stocks. At its core, value investing is about buying high-quality companies at a discount to their intrinsic value. This means looking beyond short-term market fluctuations and focusing on a company's long-term financial health and growth prospects. By doing so, value investors can potentially generate significant returns over the long term while minimizing risk. In this chapter, we will explore the key metrics that value investors use to evaluate companies, including earnings growth, cash flow, and debt levels. We will also discuss the importance of a margin of safety and fundamental analysis in value investing, and how these principles can help investors identify undervalued stocks and minimize risk. Whether you are new to value investing or a seasoned pro, this chapter will provide a solid foundation for understanding the key principles and metrics that underpin this investment strategy. So let's dive in and explore the fundamentals of value investing. The importance of understanding financial statements. Understanding financial statements is crucial for any investor, especially for those practicing value investing. Financial statements provide a company's financial information in a structured format, making it easier for investors to analyze and evaluate a company's financial health and growth potential. There are three main financial statements that investors should understand. 1. Income statement. This statement provides information on a company's revenues, expenses, and profits over a specific period of time. It shows how much money the company made and how much it spent during that period. 2. Balance sheet. This statement provides information on a company's assets, liabilities, and equity at a specific point in time. It shows what the company owns, what it owes, and how much it is worth. 3. Cash flow statement. This statement provides information on a company's cash inflows and outflows over a specific period of time. It shows how much cash the company generated from its operations, how much it spent on investments and financing, and how much cash it has left at the end of the period. By analyzing these financial statements, investors can gain insight into a company's financial health and growth potential. For example, a company with strong revenue growth and increasing profits may be a good candidate for investment, while a company with declining revenues and profits may be a red flag. Furthermore, understanding financial statements allows investors to identify key financial ratios such as the price-to-earnings ratio, price-to-book ratio, and debt-to-equity ratio. These ratios can help investors evaluate a company's valuation and determine whether it is undervalued or overvalued. In summary, understanding financial statements is a fundamental skill for any investor, especially those practicing value investing. By analyzing a company's financial statements, investors can gain insight into its financial health and growth potential, identify key financial ratios, and determine whether it is a good candidate for investment. The different financial statements and what to look for when analyzing them. As we discussed in the previous section, financial statements provide a wealth of information for investors to analyze a company's financial health and growth potential. In this section, we will go into more detail about each financial statement and what to look for when analyzing them. 1. Income statement. This statement shows a company's revenue, expenses, and net income over a specific period of time. When analyzing the income statement, investors should look for trends in revenue growth, gross profit margin, operating income, and net income. Ideally, investors want to see consistent revenue growth and increasing profit margins over time. 2. Balance sheet. This statement shows a company's assets, liabilities, and equity at a specific point in time. When analyzing the balance sheet, investors should look for trends in the company's assets, liabilities, and equity over time. They should also pay attention to the debt-to-equity ratio, which shows how much debt a company has relative to its equity. A high debt-to-equity ratio can indicate financial risk. 3. Cash flow statement. This statement shows a company's cash inflows and outflows over a specific period of time. When analyzing the cash flow statement, investors should pay attention to the operating cash flow, which shows how much cash the company generates from its operations. They should also look at the investing and financing sections of the statement to see how the company is investing its cash and financing its operations. In addition to these 3 financial statements, investors should also consider other financial metrics, such as earnings per share, EPS, price-to-earnings ratio, P/E ratio, and price-to-book ratio, P/B ratio. These ratios can help investors evaluate a company's valuation and determine whether it is undervalued or overvalued. Overall, when analyzing financial statements, investors should look for trends and consistency over time. They should also consider the company's industry and competitors to determine whether the company is performing well relative to its peers. By analyzing financial statements and other financial metrics, investors can gain valuable insights into a company's financial health and growth potential, which can help inform their investment decisions. Chapter 3. The Balance Sheet. The balance sheet is one of the most important financial statements for investors to analyze when practicing value investing. It provides a snapshot of a company's financial health at a specific point in time, showing what the company owns, assets, what it owes, liabilities, and how much is left over for shareholders, equity. In Chapter 3, we will delve deeper into the balance sheet and explore its importance in value investing. We will discuss the different components of the balance sheet, such as current assets, non-current assets, current liabilities, and non-current liabilities, and what they tell us about a company's financial health. We will also discuss key financial ratios, such as the debt-to-equity ratio and the current ratio, that can help investors evaluate a company's financial risk and liquidity. Understanding the balance sheet is crucial for value investors, as it can provide valuable insights into a company's financial health and growth potential. By analyzing the balance sheet, investors can determine whether a company has a strong financial foundation and is well positioned for long-term success. In Chapter 3, we will explore the balance sheet in detail and discuss how value investors can use it to inform their investment decisions. The importance of the balance sheet in value investing. The balance sheet is a crucial tool for value investors because it provides a snapshot of the company's financial health at a specific point in time. The balance sheet shows a company's assets, liabilities, and equity, which can help investors evaluate a company's financial position, liquidity, and solvency. When practicing value investing, investors aim to identify companies that are undervalued by the market. To do so, investors need to evaluate a company's intrinsic value, which is the true value of a company's stock based on its underlying assets and earnings potential. The balance sheet plays a critical role in determining a company's intrinsic value, as it provides insight into the company's financial position and asset base. For example, value investors may look at a company's non-current assets, such as property, plant, and equipment, to determine whether the company has valuable physical assets that can be used to generate future profits. They may also look at the company's current assets, such as cash and accounts receivable, to determine whether the company has the liquidity to meet its short-term obligations. In addition to evaluating a company's asset base, value investors also consider the company's liabilities. By examining a company's liabilities, investors can determine whether the company is burdened with excessive debt that could impact its long-term viability. The balance sheet can provide insight into a company's debt-to-equity ratio, which can help investors evaluate a company's financial risk and solvency. Overall, the balance sheet is a critical component of value investing, as it provides a window into a company's financial health and intrinsic value. By analyzing the balance sheet, investors can gain valuable insights into a company's assets, liabilities, and equity, which can help inform their investment decisions. How to read and interpret the balance sheet. To effectively practice value investing, investors must know how to read and interpret a company's balance sheet. The balance sheet is divided into 3 sections: assets, liabilities, and equity. Here's how to read and interpret each section. Assets. Current assets. These are assets that can be easily converted into cash within a year. Examples include cash, accounts receivable, and inventory. Non-current assets. These are long-term assets that cannot be easily converted into cash. Examples include property, plant, and equipment, and intangible assets like patents and trademarks. When analyzing a company's assets, value investors should consider the following: the composition of the asset base. What types of assets does the company have? Are they valuable and generating profits? The liquidity of the assets. Can the company easily convert its assets into cash if necessary? The trends in asset values. Are the company's assets increasing or decreasing in value over time? Liabilities. Current liabilities. These are short-term debts that the company must pay within a year. Examples include accounts payable and short-term loans. Non-current liabilities. These are long-term debts that the company must pay over a period of more than a year. Examples include long-term loans and bonds. When analyzing a company's liabilities, value investors should consider the following: the company's debt-to-equity ratio. This ratio compares a company's debt to its equity and helps investors evaluate the company's financial risk. The company's ability to pay off its debts. Can the company meet its debt obligations in the short term and long term? The trends in liability values. Are the company's liabilities increasing or decreasing over time? Equity. Common stock. This represents the ownership stake in the company held by shareholders. Retained earnings. This represents the company's profits that have been reinvested in the business. When analyzing a company's equity, value investors should consider the following: the company's return on equity, ROE. This ratio measures the company's ability to generate profits from shareholder investments. The company's dividend payout. Does the company pay dividends to shareholders, and if so, how much? Overall, to effectively read and interpret a company's balance sheet, value investors should consider the composition and liquidity of the company's assets, the company's debt-to-equity ratio and ability to pay off its debts, and the company's return on equity and dividend payout. By analyzing these factors, investors can gain valuable insights into a company's financial health and intrinsic value. Chapter 4. The Income Statement. Welcome to Chapter 4, The Income Statement. In this chapter, we will be exploring another key financial statement that is essential to value investing, the income statement. The income statement provides investors with a detailed overview of a company's revenue and expenses over a specific period of time, typically a quarter or a year. By analyzing the income statement, value investors can gain insights into a company's profitability and growth potential, which are crucial factors in determining its intrinsic value. In this chapter, we will delve into the importance of the income statement in value investing, its components, and how to read and interpret it effectively. Understanding the income statement is essential for any value investor looking to make informed investment decisions based on a company's financial performance. So let's dive in and explore the fundamentals of the income statement. The importance of the income statement in value investing. The income statement is a crucial financial statement for value investors, as it provides valuable insights into a company's financial performance and profitability over a specific period of time. Here are some reasons why the income statement is important in value investing. 1. Profitability. The income statement shows a company's revenue and expenses, which are used to calculate its net income or profit. As a value investor, analyzing a company's profitability is essential in determining its intrinsic value. A company with a consistent and growing net income is often considered more valuable than one with a declining net income. 2. Growth potential. The income statement also provides information on a company's revenue growth rate and the trends in its expenses. By analyzing these factors, value investors can gain insights into a company's growth potential and identify any areas where it may be experiencing challenges. 3. Comparability. The income statement allows for the comparison of a company's financial performance over time, as well as with its competitors. Value investors often use financial ratios such as the price-to-earnings ratio, P/E ratio, or the earnings per share, EPS, to compare companies within the same industry or sector. 4. Forecasting. The income statement can also be used to forecast a company's future earnings potential. By analyzing trends in revenue and expenses, value investors can make informed predictions about a company's future financial performance. In summary, the income statement is a critical financial statement for value investors, as it provides insights into a company's profitability, growth potential, comparability, and forecasting capabilities. By analyzing the income statement, value investors can make informed investment decisions based on a company's financial performance and intrinsic value. How to read and interpret the income statement. Reading and interpreting the income statement is essential for value investors looking to make informed investment decisions. Here is a step-by-step guide on how to read and interpret the income statement. 1. Start with revenue. The income statement starts with the company's total revenue for the specific period, which is usually a quarter or a year. Revenue represents the amount of money generated from the sale of goods or services. 2. Look at the cost of goods sold. The cost of goods sold, COGS, represents the direct costs associated with producing the goods or services sold during the period. COGS includes costs such as raw materials, labor, and manufacturing overhead. 3. Calculate gross profit. Gross profit is calculated by subtracting COGS from revenue. This represents the amount of money left over after direct costs are deducted. 4. Analyze operating expenses. Operating expenses include all expenses related to running the company, such as salaries, rent, and marketing costs. Subtracting operating expenses from gross profit gives you operating income. 5. Consider other income and expenses. Other income and expenses may include things like interest income, investment gains or losses, and taxes. These items are typically listed separately on the income statement. 6. Calculate net income. Net income is the final amount listed on the income statement and represents the total profit or loss for the period. 7. Analyze trends. Value investors should analyze trends in the income statement over time to identify any patterns or changes in the company's financial performance. For example, if revenue is consistently increasing, this may indicate a growing company with strong potential. 8. Use financial ratios. Financial ratios such as the price-to-earnings ratio, P/E ratio, or the earnings per share, EPS, can be used to compare a company's financial performance to its peers or industry standards. In summary, understanding how to read and interpret the income statement is crucial for value investors looking to make informed investment decisions. By analyzing trends and using financial ratios, value investors can gain insights into a company's financial performance and determine its intrinsic value. Chapter 5. The Cash Flow Statement. Welcome to Chapter 5 of our book on value investing. In this chapter, we will be discussing one of the most important financial statements for investors, the cash flow statement. While the balance sheet and income statement provide important insights into a company's financial health, the cash flow statement offers a different perspective on a company's financial performance. As the name suggests, the cash flow statement tracks the flow of cash into and out of a company during a specific period. This statement shows the cash generated by a company's operations, as well as any cash spent on investing activities or financing activities. Understanding a company's cash flow is crucial for value investors looking to make informed investment decisions. In this chapter, we will explore the importance of the cash flow statement in value investing and explain how to read and interpret this statement. We will also discuss the different components of the cash flow statement and how they relate to a company's overall financial health. By the end of this chapter, you will have a clear understanding of how to use the cash flow statement to assess a company's intrinsic value and make informed investment decisions. The importance of the cash flow statement in value investing. The cash flow statement is an essential financial statement for value investors looking to assess a company's financial health and intrinsic value. Here are some reasons why the cash flow statement is important in value investing. 1. Shows the cash generated by operations. The cash flow statement provides insights into a company's cash generated by operations, which is a crucial indicator of a company's financial health. A company that consistently generates positive cash flow from its operations is generally considered financially stable. 2. Indicates capital expenditures. The cash flow statement also shows a company's capital expenditures, which are the investments made in long-term assets such as property, plant, and equipment. Understanding a company's capital expenditures is important for value investors because it can impact the company's future earnings potential. 3. Reveals financing activities. The cash flow statement provides insights into a company's financing activities, such as debt issuance, stock repurchases, and dividend payments. By analyzing a company's financing activities, value investors can gain insights into the company's financial strategy and evaluate its potential for growth. 4. Offers a different perspective on the company's financial health. While the balance sheet and income statement provide important information, the cash flow statement offers a different perspective on a company's financial health. For example, a company may show strong earnings on the income statement but have negative cash flow due to high capital expenditures. In summary, the cash flow statement is a critical tool for value investors looking to assess a company's intrinsic value. By providing insights into a company's cash generated from operations, capital expenditures, and financing activities, the cash flow statement can help investors make informed investment decisions. How to read and interpret the cash flow statement. The cash flow statement can be a little overwhelming for those unfamiliar with financial statements, but it is essential for value investors to understand how to read and interpret this statement. Here are the key steps for reading and interpreting the cash flow statement. 1. Identify the operating cash flow section. The first section of the cash flow statement shows the cash generated by a company's operations. This section includes items such as net income, depreciation and amortization, and changes in working capital. 2. Analyze changes in working capital. Changes in working capital, such as accounts receivable, accounts payable, and inventory, can impact a company's cash flow from operations. Analyzing changes in working capital can provide insights into a company's financial health. 3. Review the investing cash flow section. The second section of the cash flow statement shows the cash spent on investing activities, such as capital expenditures and acquisitions. Analyzing this section can help investors evaluate a company's long-term growth potential. 4. Evaluate the financing cash flow section. The third section of the cash flow statement shows the cash spent on financing activities, such as debt repayments, stock buybacks, and dividend payments. Analyzing this section can provide insights into a company's financial strategy and potential for growth. 5. Calculate free cash flow. Free cash flow is the cash a company generates after accounting for its capital expenditures. Calculating free cash flow is important for value investors looking to assess a company's intrinsic value. 6. Compare cash flow to earnings. Finally, it's important to compare a company's cash flow to its earnings. If a company consistently generates positive cash flow but has low earnings, it may indicate that the company is investing heavily in long-term growth opportunities. In conclusion, reading and interpreting the cash flow statement is an essential skill for value investors. By understanding the different sections of the statement and analyzing changes in working capital, investing activities, and financing activities, investors can gain insights into a company's financial health and intrinsic value. Chapter 6. Financial Ratios. In value investing, analyzing financial ratios is an essential tool for evaluating the financial health and performance of a company. Financial ratios provide a quantitative way to assess a company's profitability, liquidity, efficiency, and overall financial strength. In Chapter 6, we will delve into the world of financial ratios and explore their importance in value investing. We will discuss the most commonly used financial ratios and how to interpret them to make informed investment decisions. Understanding financial ratios is crucial for value investors to identify undervalued companies and make profitable investment decisions. The different financial ratios used in value investing. There are numerous financial ratios used in value investing, each with its own specific purpose and value. Here are some of the most commonly used financial ratios in value investing. 1. Price-to-earnings ratio, P/E. This ratio compares a company's stock price to its earnings per share. It is a key indicator of a company's valuation and is commonly used to compare the relative value of different companies in the same industry. 2. Price-to-book ratio, P/B. This ratio compares a company's stock price to its book value per share. It is a useful indicator of a company's tangible assets and can be used to identify undervalued companies. 3. Price-to-sales ratio, P/S. This ratio compares a company's stock price to its revenue per share. It is useful for evaluating companies with low profit margins or negative earnings. 4. Debt-to-equity ratio. This ratio compares a company's total debt to its equity. It is a useful indicator of a company's financial leverage and risk. 5. Return on equity, ROE. This ratio compares a company's net income to its shareholders' equity. It is a measure of how effectively a company is using its equity to generate profits. 6. Return on assets, ROA. This ratio compares a company's net income to its total assets. It is a measure of how efficiently a company is using its assets to generate profits. 7. Current ratio. This ratio compares a company's current assets to its current liabilities. It is a measure of a company's liquidity and ability to pay its short-term debts. 8. Quick ratio. This ratio compares a company's liquid assets to its current liabilities. It is a measure of a company's ability to meet its short-term obligations. Understanding and analyzing these financial ratios can provide valuable insights into a company's financial health and performance, helping value investors identify undervalued stocks and make informed investment decisions. How to use financial ratios to evaluate a company's financial health. Financial ratios provide a quantitative way to evaluate a company's financial health and performance. By analyzing financial ratios, value investors can gain insights into a company's profitability, liquidity, efficiency, and overall financial strength. Here are some steps to using financial ratios to evaluate a company's financial health. 1. Choose the appropriate financial ratios. Select the financial ratios that are most relevant to the industry and the specific company you are analyzing. Different industries and companies have different financial characteristics, and different ratios will be more informative depending on the situation. 2. Gather the necessary data. Collect the financial statements and other relevant financial data for the company you are analyzing. Ensure that the financial statements are accurate and up to date. 3. Calculate the ratios. Calculate the financial ratios using the data gathered in the previous step. Double-check the calculations to ensure accuracy. 4. Interpret the ratios. Analyze the calculated ratios and compare them to industry benchmarks and the company's historical performance. Look for trends, patterns, and anomalies that may indicate areas of strength or weakness. 5. Make informed investment decisions. Use the insights gained from the ratio analysis to make informed investment decisions. Identify undervalued companies that may be good investment opportunities, or avoid overvalued companies that may be risky investments. By using financial ratios to evaluate a company's financial health, value investors can gain a deeper understanding of the company's financial performance and make more informed investment decisions. However, it is important to note that financial ratios are just one tool in the value investor's toolbox and should be used in conjunction with other fundamental analysis techniques. Chapter 7. Valuation Methods. In order to make informed investment decisions, value investors need to have a solid understanding of how to value a company. Valuation methods are crucial for determining the true worth of a company and whether it is undervalued or overvalued in the market. In this chapter, we will discuss various valuation methods used in value investing and how to apply them to make investment decisions. Valuation methods are important because they provide a framework for evaluating the financial health of a company and estimating its potential future performance. By using these methods, investors can determine the intrinsic value of a company, which is the true value of the company based on its underlying financial and operational factors, as opposed to its market price. In this chapter, we will discuss some of the most commonly used valuation methods, including discounted cash flow, DCF analysis, price to earnings, P/E ratio, price to book, P/B ratio, and dividend discount model, DDM. We will also discuss the pros and cons of each method and when they are most appropriate to use. By understanding valuation methods, value investors can make informed investment decisions based on the underlying value of a company rather than just the market price. This chapter will provide valuable insights into the art of valuation and how to apply it to value investing. The different valuation methods used in value investing. Value investors use various valuation methods to determine the intrinsic value of a company, which is the true value of the company based on its underlying financial and operational factors. In this section, we will discuss some of the most commonly used valuation methods in value investing. 1. Discounted cash flow, DCF analysis. This is a valuation method that estimates the present value of a company's future cash flows. It involves projecting future cash flows of the company, discounting them back to the present using a discount rate, and arriving at the present value of those cash flows. This method is widely used in value investing because it focuses on the company's future earnings potential, which is a key factor in determining its value. 2. Price to earnings, P/E ratio. This is a valuation method that compares a company's stock price to its earnings per share, EPS. It is calculated by dividing the stock price by the EPS. This method is commonly used in value investing because it provides a quick way to compare the relative value of different companies within the same industry. 3. Price to book, P/B ratio. This is a valuation method that compares a company's stock price to its book value per share. It is calculated by dividing the stock price by the book value per share. This method is commonly used in value investing because it provides a measure of the company's tangible assets and the market's perception of its value. 4. Dividend discount model, DDM. This is a valuation method that estimates the intrinsic value of a company based on its future dividend payments. It involves projecting future dividends, discounting them back to the present using a discount rate, and arriving at the present value of those dividends. This method is commonly used in value investing for companies that pay consistent and predictable dividends. These are just a few examples of the valuation methods used in value investing. Each method has its own strengths and weaknesses, and value investors often use multiple methods to arrive at a more accurate estimate of a company's intrinsic value. It is important to understand these valuation methods and their applications in order to make informed investment decisions based on the underlying value of a company. How to use valuation methods to determine the intrinsic value of a company. Valuation methods are used by value investors to determine the intrinsic value of a company, which is the true value of the company based on its underlying financial and operational factors. In this section, we will discuss how to use valuation methods to determine the intrinsic value of a company. 1. Discounted cash flow, DCF, analysis. To use DCF analysis, one must first project the company's future cash flows, taking into account various factors such as growth rates, expenses, and capital expenditures. Then, a discount rate must be applied to these cash flows to account for the time value of money. The present value of the future cash flows is the intrinsic value of the company. 2. Price to earnings, P/E ratio. To use P/E ratio, one must first determine the company's current earnings per share, EPS, and the current stock price. The P/E ratio is then calculated by dividing the stock price by the EPS. The P/E ratio of other companies in the same industry can be used as a benchmark for comparison. A low P/E ratio suggests that the company is undervalued, while a high P/E ratio suggests that the company is overvalued. 3. Price to book, P/B ratio. To use P/B ratio, one must first determine the company's book value per share and the current stock price. The P/B ratio is then calculated by dividing the stock price by the book value per share. Similar to P/E ratio, the P/B ratio of other companies in the same industry can be used as a benchmark for comparison. A low P/B ratio suggests that the company is undervalued, while a high P/B ratio suggests that the company is overvalued. 4. Dividend Discount Model, DDM. To use DDM, one must first determine the company's future dividend payments and the discount rate. Future dividends are projected based on the company's historical dividend payments, growth rates, and other relevant factors. The discount rate is used to calculate the present value of these future dividends. The sum of the present value of future dividends is the intrinsic value of the company. It is important to note that these valuation methods are not perfect and can be affected by various external factors. It is recommended to use multiple valuation methods and conduct a thorough analysis of the company's financial and operational factors before making an investment decision. By using these valuation methods, value investors can determine the intrinsic value of a company and make informed investment decisions based on its underlying value. Chapter 8. Margin of Safety. Introduction. Value investing is not only about finding undervalued stocks, but it also involves protecting oneself from potential losses. This is where the concept of margin of safety comes in. Margin of safety is a crucial component of value investing and involves buying stocks that have a margin of safety, which is the difference between a stock's intrinsic value and its market price. The margin of safety provides a buffer against unexpected events that could result in a decline in the stock's value. In this chapter, we will discuss the concept of margin of safety in more detail and explain why it is essential for value investors. We will also provide practical examples of how to calculate the margin of safety and use it to make investment decisions. Understanding the margin of safety will help you make informed investment decisions and minimize your risk in the stock market. Margin of safety and its importance in value investing. Margin of safety is a concept in value investing that involves buying stocks at a price significantly below their intrinsic value. It is the difference between a stock's intrinsic value and its market price. The intrinsic value is the true value of a stock based on its underlying financial performance and future growth potential. The market price, on the other hand, is the current price of the stock in the stock market. The margin of safety provides a cushion for investors in case their assumptions about a stock's intrinsic value are incorrect or unexpected events occur that cause the stock's price to decline. By buying stocks with a margin of safety, investors can reduce the risk of losses and potentially earn higher returns. For example, if a stock has an intrinsic value of $50 per share, but its market price is only $30 per share, the margin of safety is $20 per share. This means that even if the stock's intrinsic value decreases by $20 per share, the investor would still break even. A larger margin of safety provides more protection against downside risks. In value investing, the margin of safety is often used to determine whether a stock is undervalued or overvalued. A stock with a high margin of safety is considered undervalued, while a stock with a low margin of safety is considered overvalued. By focusing on stocks with a high margin of safety, value investors aim to minimize their risk and increase their potential returns. In summary, margin of safety is an essential concept in value investing, as it helps investors to protect themselves against potential losses and make informed investment decisions. By understanding the concept of margin of safety and using it to analyze stocks, investors can increase their chances of earning significant returns over the long term. How to calculate the margin of safety for a company. Calculating the margin of safety involves estimating a stock's intrinsic value and then comparing it to the stock's current market price. There are different methods to estimate intrinsic value, but some of the commonly used approaches include discounted cash flow, DCF analysis, price to earnings, P/E ratio analysis, and price to book, P/B ratio analysis. Once you have estimated the intrinsic value of a stock using one or more of these methods, you can calculate the margin of safety by subtracting the market price from the estimated intrinsic value. The resulting value is the amount by which the stock is undervalued, which provides a cushion for investors in case their assumptions about the stock's intrinsic value are incorrect. For example, let's say that you have estimated the intrinsic value of a stock to be $50 per share using a DCF analysis. If the stock's current market price is $30 per share, the margin of safety would be $20 per share. $50 minus $30 equals $20. This means that the stock is undervalued by $20 per share, which provides a cushion for investors in case the stock's price declines or unexpected events occur. It is important to note that calculating the margin of safety is not an exact science and requires making assumptions about future financial performance and growth potential. Therefore, it is essential to conduct thorough research and analysis to ensure that your assumptions are reasonable and based on sound reasoning. In conclusion, calculating the margin of safety involves estimating the intrinsic value of a stock and then comparing it to the stock's market price. By focusing on stocks with a high margin of safety, value investors aim to minimize their risk and increase their potential returns. Chapter 9. Economic Moat. Welcome to Chapter 9 of our book on value investing. In this chapter, we will discuss the concept of an economic moat and its importance in value investing. An economic moat refers to a competitive advantage that a company has over its peers, which makes it difficult for other companies to enter its market and erode its profitability. A company with a wide economic moat is more likely to sustain its competitive advantage and generate higher profits over the long term. Identifying companies with a strong economic moat is a crucial aspect of value investing. By investing in companies with a sustainable competitive advantage, value investors aim to benefit from their long-term growth potential and generate higher returns on their investments. In this chapter, we will discuss the different types of economic moats and how to identify companies with a wide economic moat. We will also examine case studies of companies with strong economic moats and how their competitive advantages have contributed to their success. So, let's dive in and explore the concept of economic moats in more detail. The concept of economic moat and its importance in value investing. An economic moat refers to a sustainable competitive advantage that a company has over its peers. It can arise from various factors such as brand recognition, patents, economies of scale, network effects, and high switching costs for customers. Companies with a wide economic moat tend to have a higher likelihood of maintaining their competitive advantage and generating long-term profits, making them attractive investments for value investors. One of the key advantages of investing in companies with a wide economic moat is that they can better weather economic downturns and market fluctuations. Companies with a sustainable competitive advantage are better positioned to withstand industry disruptions and maintain their market share, ensuring that they can continue generating profits even when times are tough. Another benefit of investing in companies with a strong economic moat is the potential for long-term growth. Such companies are often leaders in their respective industries, which means they can capitalize on growth opportunities and expand their market share over time. Additionally, companies with an economic moat often have pricing power, allowing them to charge premium prices for their products or services and generate higher profits. In summary, identifying companies with a wide economic moat is a critical aspect of value investing. By investing in companies with a sustainable competitive advantage, value investors aim to benefit from their long-term growth potential and generate higher returns on their investments. In the next section, we will discuss the different types of economic moats and how to identify them. How to identify a company's economic moat. Identifying a company's economic moat is an essential part of value investing. It requires analyzing the company's competitive position within its industry and identifying the factors that give it a sustainable competitive advantage. One way to identify a company's economic moat is to examine its financial statements and performance metrics. Look for companies that consistently generate high returns on invested capital, ROIC, and have a strong track record of profitability over the long term. This can be an indication that the company has a competitive advantage that allows it to earn higher returns than its peers. Another approach is to analyze the company's industry and competitive landscape. Look for companies that operate in industries with high barriers to entry, such as those with significant regulatory hurdles, high capital requirements, or complex technologies. Companies that have a leading market share or dominant position in their industry may also have an economic moat. In addition, consider the company's brand recognition, customer loyalty, and pricing power. Companies that have a strong brand and loyal customer base may be less susceptible to competition from new entrants. Companies with pricing power can maintain their profitability even in a highly competitive market. Finally, consider the company's intangible assets, such as patents, trademarks, and proprietary technologies. These can provide a competitive advantage that is difficult for competitors to replicate. It's essential to keep in mind that economic moats are not foolproof. Industries can change rapidly, and new technologies can disrupt existing business models, rendering a company's competitive advantage obsolete. Therefore, it's important to continuously monitor the company's competitive position and adapt to changing market conditions. Chapter 10. Competitive Advantage. In today's competitive business environment, companies need to have a unique advantage over their rivals to succeed. This advantage is known as a competitive advantage, which allows a company to outperform its competitors over the long term. In this chapter, we will discuss the concept of competitive advantage and how it relates to value investing. We will also look at some examples of companies that have a competitive advantage and how value investors can identify these companies. The concept of competitive advantage and its importance in value investing. A competitive advantage is a unique advantage that a company has over its competitors, which allows it to generate higher profits or revenue than its competitors over the long term. In the context of value investing, A company's competitive advantage is a key factor in determining its intrinsic value and potential for long-term growth. A company with a sustainable competitive advantage has a higher likelihood of generating consistent profits and revenue growth, which translates into higher shareholder value over time. Value investors look for companies that have a competitive advantage that is difficult for competitors to replicate or surpass, giving them an economic moat. There are several types of competitive advantages that a company can have, such as 1. Cost advantage. This is when a company can produce goods or services at a lower cost than its competitors, either through economies of scale, efficient production processes, or access to cheaper inputs. 2. Differentiation advantage. This is when a company offers a unique product or service that is not easily replicated by its competitors. This could be due to proprietary technology, strong brand recognition, or a unique distribution network. 3. Network advantage. This is when a company has built a strong network of partners, suppliers, or customers that is difficult for competitors to replicate. Identifying a company's competitive advantage is an important part of value investing. A company with a strong competitive advantage will have a higher intrinsic value, making it an attractive investment opportunity for value investors. Additionally, a company with a competitive advantage is more likely to withstand market downturns and economic disruptions, providing a cushion for investors during tough times. How to identify a company's competitive advantage. Identifying a company's competitive advantage is an essential aspect of value investing. A competitive advantage is the unique edge that a company possesses, which sets it apart from its competitors. This advantage could be in the form of a proprietary technology, a strong brand, economies of scale, or any other factor that enables the company to achieve sustained profitability and market dominance. One way to identify a company's competitive advantage is to analyze its business model and operations. Look for factors that contribute to the company's success, such as a low-cost production process, exclusive distribution channels, or strong customer loyalty. Another approach is to study the company's financial statements and track its performance relative to its competitors over time. Investors can also examine the company's management team and their strategic decisions to gain insights into the company's competitive advantage. For instance, if the company invests heavily in research and development, this could indicate a commitment to maintaining a technological edge over its competitors. In summary, identifying a company's competitive advantage requires a thorough understanding of its operations, financial performance, and management strategies. This knowledge can help investors make informed decisions about the company's long-term prospects and potential for sustained growth. Chapter 11. Management. The success of a company largely depends on the quality of its management team. In this chapter, we will discuss the importance of management in value investing and how to evaluate a company's management team. Good management can make a company thrive, while poor management can lead to its downfall. Therefore, it is crucial to assess the capabilities and track record of a company's management team before investing in its stock. The importance of management in value investing. The importance of management cannot be overstated when it comes to value investing. A company's management team is responsible for making crucial decisions that can have a significant impact on the company's financial health, growth prospects, and shareholder value. A competent management team can lead a company to success by making sound strategic decisions, effectively managing resources, and fostering a strong company culture. On the other hand, poor management can make a company falter and ultimately fail. When evaluating a company for investment, it is essential to assess the quality of its management team. A strong management team with a proven track record of making sound business decisions and driving growth can be a strong indicator of a company's potential for success. Conversely, a weak management team with a history of poor decision-making and a lack of direction can be a warning sign for investors to stay away. In value investing, a company's management team is considered a critical factor in determining its intrinsic value. Good management can create an economic moat around a company by building a strong brand, fostering innovation, and effectively managing costs. A company with a strong economic moat is more likely to maintain its competitive advantage and generate long-term profits, making it a desirable investment for value investors. Overall, the quality of a company's management team is a critical factor to consider when making investment decisions. Investors must carefully evaluate a company's leadership to assess its potential for long-term growth and success. How to evaluate a company's management team. Evaluating a company's management team is an essential step in value investing. A company's success depends on its management team's ability to make strategic decisions, allocate resources, and lead the company towards achieving its goals. Therefore, investors must analyze the management team's background, experience, and leadership style before investing in a company. One way to evaluate management is by looking at their track record. Investors can research the management team's past successes and failures in leading other companies. This information can help investors assess the management team's ability to navigate challenging situations and make sound decisions. Another important factor to consider is the management team's alignment with shareholders' interests. Investors should look for management teams that have a significant stake in the company and are committed to creating long-term shareholder value. Additionally, investors should analyze the management team's compensation structure to ensure it aligns with the company's performance and shareholder interests. Investors should also consider the management team's communication style and transparency. A management team that is open and transparent with its investors can help build trust and confidence in the company. Investors should look for management teams that provide regular updates on the company's performance, future plans, and any potential risks or challenges. Overall, evaluating a company's management team is crucial in value investing. By analyzing the management team's track record, alignment with shareholder interests, communication style, and transparency, investors can make more informed investment decisions. Chapter 12. The Importance of Patience. Investing, particularly value investing, requires a considerable amount of patience. Many investors are often in a rush to see quick returns on their investments, but value investing is not a get-rich-quick scheme. Rather, it is a long-term strategy that requires a significant amount of patience and discipline. This chapter will explore the importance of patience in value investing and how it can help investors make better investment decisions. We will discuss the benefits of taking a long-term approach to investing, the dangers of impatience, and provide tips on how to cultivate patience as an investor. By the end of this chapter, readers will have a better understanding of why patience is critical to the success of value investing. The importance of patience in value investing. Patience is a virtue that is highly valued in the world of value investing. Unlike other investment strategies that focus on short-term gains, value investing involves a long-term approach that requires patience and discipline. Value investors look for companies that are undervalued by the market and hold on to these investments for an extended period, waiting for the market to recognize the true value of the company. This approach requires patience because it may take months or even years for the market to recognize the true value of a company. Value investors are willing to wait because they believe that the long-term potential of a company is far more important than short-term fluctuations in the stock price. Furthermore, patience is crucial in value investing because it allows investors to avoid making impulsive decisions. Value investors often have a strict set of criteria that they use to evaluate companies, and they are willing to wait until they find a company that meets these criteria. By exercising patience, value investors can avoid the temptation to chase after the latest hot stock or make rash investment decisions based on short-term market fluctuations. Why value investing is a long-term strategy. Value investing is a long-term investment strategy that involves finding undervalued companies and holding their stocks until the market recognizes their true worth. Patience is an essential characteristic of value investing, as it takes time for the market to correct its mistakes and for the value of a company to be fully realized. Value investors believe that short-term market fluctuations do not reflect the true value of a company and that a focus on the long-term outlook is crucial. The strategy requires a disciplined approach to buying and holding stocks for extended periods, regardless of the ups and downs of the market. The patience of a value investor also means that they are willing to wait for the right opportunity to come along. They do not rush into buying stocks just because they are available or popular, but instead, they wait for a company to become undervalued due to temporary setbacks or market misconceptions. Overall, the importance of patience in value investing cannot be overstated. It is an essential component of the strategy, and investors who lack patience are more likely to make hasty decisions that could lead to losses in the long run. Chapter 13: Common Mistakes to Avoid. Welcome to Chapter 13 of our book on value investing. In this chapter, we will be discussing the common mistakes that investors make when practicing value investing. While value investing can be a profitable strategy, it is not without its pitfalls, and even experienced investors can fall into the same traps repeatedly. By identifying and avoiding these mistakes, investors can maximize their returns and minimize their losses. So, let's dive in and explore the common mistakes to avoid in value investing. Common mistakes made by value investors. While value investing can be a highly effective investment strategy, there are several common mistakes that investors often make. These mistakes can lead to poor investment decisions, missed opportunities, and ultimately, underperformance. One common mistake is failing to adequately research and analyze a company before making an investment. Value investors must carefully scrutinize a company's financial statements, competitive positioning, management team, and other relevant factors before determining its intrinsic value and potential for future growth. Rushing through this process or skipping it altogether can lead to overpaying for a stock or investing in a company with a weak competitive position or ineffective management. Another common mistake is becoming too emotionally attached to an investment. Value investors must remain objective and rational, basing their investment decisions on the facts and analysis rather than emotions or hunches. Holding onto a stock simply because it was a good investment in the past, or refusing to sell even when the company's fundamentals deteriorate, can lead to significant losses. Timing is another important consideration for value investors. Buying a stock when it is undervalued is critical, but it is equally important to sell when the stock reaches its intrinsic value or when the investment thesis is no longer valid. Failing to sell when the time is right can result in missed opportunities and reduced returns. Finally, value investors must be patient and disciplined. It can take time for a company to realize its potential and for the market to recognize its true value. Jumping in and out of stocks in response to short-term market fluctuations or news can lead to missed opportunities and suboptimal returns. Sticking to a long-term investment strategy and being patient can lead to significant gains over time. By avoiding these common mistakes and adhering to a disciplined, long-term investment approach, value investors can increase their chances of success and achieve their financial goals. How to avoid these mistakes. Value investing can be a highly effective investment strategy, but like any other investment approach, it is not immune to mistakes. Here are a few common mistakes that value investors make. 1. Failing to do proper research. One of the biggest mistakes value investors make is not conducting proper research before investing. This can lead to investing in companies that are not undervalued or have weak financials, which can result in significant losses. 2. Overemphasizing financial metrics. While financial metrics are essential in value investing, overemphasizing them can lead to overlooking other important factors, such as the company's industry position, management quality, and competitive advantage. 3. Failing to re-evaluate investments. Value investing requires patience, but it does not mean that investors should hold onto a stock forever. Failing to re-evaluate investments periodically can lead to holding onto a stock that is no longer undervalued or has deteriorated financials. 4. Focusing on short-term price movements. Value investing is a long-term strategy, and short-term price movements should not distract investors from the underlying value of a company. To avoid these mistakes, value investors should conduct proper research, thoroughly analyze financial and non-financial metrics, periodically reevaluate their investments, and focus on the long-term value of a company rather than short-term price movements. Additionally, investors should continuously learn and adapt their strategies based on the market conditions and their experiences. Chapter 14. The Psychology of Investing. Investing can be a challenging endeavor, both financially and emotionally. Many investors, even seasoned professionals, struggle with making rational decisions and avoiding behavioral biases that can lead to poor investment performance. The field of behavioral finance has shed light on these psychological challenges and the ways in which they can impact our investment decisions. In this chapter, we will explore the psychology of investing and how it relates to value investing. We will discuss the various cognitive and emotional biases that can affect our decision-making, such as overconfidence, loss aversion, and herding behavior. We will also examine strategies for overcoming these biases and making more rational investment decisions. Understanding the psychology of investing is essential for value investors who seek to make sound, long-term investment decisions based on a rational analysis of a company's financials and intrinsic value. By recognizing and addressing the psychological biases that can cloud our judgment, we can increase our chances of achieving investment success. The psychological aspects of value investing. Value investing is not just about analyzing financial statements and making rational decisions based on the numbers. The psychology of investing also plays a significant role in determining investment success. Behavioral biases, emotions, and other psychological factors can affect investment decisions and lead to poor outcomes. One common psychological bias is confirmation bias, where investors tend to seek out information that confirms their existing beliefs and opinions. This can lead to ignoring or dismissing information that contradicts those beliefs, which can be detrimental to making sound investment decisions. Another psychological factor is fear and greed, which can lead to impulsive decisions based on short-term market movements rather than long-term fundamentals. Fear of missing out, FOMO, can cause investors to jump into investments without proper research or analysis, while greed can cause them to hold on to losing investments for too long in hopes of a quick turnaround. Value investors must also be aware of their own risk tolerance and emotional reactions to market volatility. They should have a clear investment plan and stick to it, avoiding the temptation to make impulsive decisions based on short-term market movements. Understanding and managing the psychological aspects of investing is crucial for value investors who seek long-term success in the stock market. How to overcome emotional biases when investing. One of the biggest challenges in value investing is managing emotions and biases. Fear, greed, and overconfidence can lead to poor investment decisions and ultimately harm investment returns. To be a successful value investor, it's important to recognize and overcome these emotional biases. One of the most common emotional biases is the fear of missing out, FOMO. This can lead investors to buy into stocks that are already overpriced or to chase returns without fully analyzing the fundamentals of a company. To overcome FOMO, value investors should focus on their investment strategy and stick to their plan, even if it means missing out on short-term gains. Another common emotional bias is loss aversion. This is the tendency to prefer avoiding losses over achieving gains, which can lead to holding on to losing stocks for too long or selling winning stocks too soon. To overcome loss aversion, value investors should focus on the long-term fundamentals of a company and make decisions based on objective analysis rather than emotional reactions. Overconfidence is another common emotional bias that can lead to overestimating the potential of a company or underestimating the risks. To avoid overconfidence, value investors should approach each investment with a critical and objective mindset, and always consider the potential downside risks. To overcome these emotional biases, value investors should have a well-defined investment strategy that is based on objective analysis of a company's fundamentals, financial statements, and valuation. It's also important to remain patient, disciplined, and focused on the long-term goals of the investment. By staying disciplined and focused, value investors can avoid common emotional biases and increase their chances of success in the market. Chapter 15. Market Cycles. Investing in the stock market is not only about identifying the right companies to invest in, but also understanding the market cycles. The market cycles are the upward and downward movements of the market, and they play a significant role in determining the returns of an investor. Market cycles are influenced by various factors such as economic growth, interest rates, and inflation rates. Market cycles can be challenging to predict, and even the most experienced investors can struggle to time the market perfectly. However, understanding market cycles can help investors make better investment decisions and avoid unnecessary risks. In this chapter, we will discuss the different phases of market cycles and their impact on value investing. We will also explore various strategies that value investors can use to navigate through different market cycles. The importance of market cycles in value investing. Market cycles are a crucial aspect of value investing, as they impact the valuation of stocks and the performance of a portfolio. Understanding the different stages of market cycles is essential for value investors, as it helps them make informed investment decisions and avoid common mistakes. Market cycles are characterized by periods of growth, contraction, and recovery, and they can have a significant impact on the prices of stocks, the overall economy, and investor sentiment. During a period of growth, the stock market tends to rise, and investors are optimistic about the future prospects of companies. However, as the economy reaches its peak, there is usually a contraction phase where the market experiences a downturn. This can be caused by a variety of factors, such as rising interest rates, geopolitical instability, or a slowdown in economic growth. During this phase, stocks may be overvalued and investors may experience losses. Finally, the market enters a recovery phase, where stocks start to rebound and investors become more optimistic. Value investors need to be aware of these cycles and adjust their investment strategies accordingly. By analyzing market cycles, value investors can identify opportunities to buy undervalued stocks during a downturn and sell overvalued stocks during periods of growth. How to navigate different market cycles. Navigating different market cycles is an essential aspect of value investing. Market cycles refer to the various stages of the economy, which may include periods of expansion, recession, or recovery. Each of these phases affects the stock market differently, and value investors must adjust their investment strategies accordingly. During times of economic expansion, stock prices tend to rise, and the demand for stocks increases. Value investors may find it difficult to find undervalued stocks during this period, and as a result, may focus on maintaining their current investments. In contrast, during economic downturns or recessions, stock prices typically fall as investor confidence decreases. This can create opportunities for value investors to identify undervalued stocks that have been overlooked by the market. However, investing during a recession requires patience and a long-term outlook, as it may take some time for the stock to recover and reach its true value. During the recovery phase, stock prices begin to rise again, and value investors may need to adjust their strategies accordingly. As the market becomes more bullish, investors may be more willing to pay a premium for growth companies, and value investors may need to be more selective in their investment choices. Overall, understanding the different phases of the market cycle is critical to successful value investing. By adapting their strategies to fit the current economic environment, value investors can identify undervalued stocks and take advantage of market opportunities. However, it is essential to remain patient and disciplined, as investing in the stock market is a long-term endeavor that requires careful planning and execution. Chapter 16. Diversification. Diversification is a risk management technique that is essential to the success of any investment strategy. The idea behind diversification is simple. By spreading your investments across different asset classes, industries, and geographies, you can minimize the impact of any single investment on your overall portfolio. In value investing, diversification plays an important role in mitigating risk and protecting capital. The goal of value investing is to identify undervalued companies with strong fundamentals and hold on to them for the long term. However, even the most thorough research and analysis can't guarantee that every investment will be a success. By diversifying your portfolio, you can reduce your exposure to any single company, industry, or market. This can help you weather market downturns, unexpected company-specific issues, or other external factors that may negatively impact your investments. In this chapter, we'll explore the concept of diversification in more detail and discuss the different ways in which value investors can diversify their portfolios to minimize risk and maximize returns. We'll also address some of the common misconceptions about diversification and explain why it's an essential part of any successful investment strategy. The importance of diversification in value investing. Diversification is a key concept in value investing, and it involves spreading your investment across multiple assets to reduce the risks of losing your entire investment. Diversification allows you to limit your exposure to any single investment or sector, and it can help you avoid the consequences of unexpected events that can impact a single company or market. One of the main advantages of diversification is that it can help you reduce the impact of market volatility on your portfolio. For example, if one of your holdings experiences a decline in value, your other investments can help cushion the impact of that loss. Additionally, diversification can help you capture gains from multiple markets and sectors, potentially leading to higher overall returns. However, it is important to note that diversification does not guarantee a profit or protect against loss. In some cases, diversification can actually reduce returns if you spread your investments too thin or if you invest in assets that are too similar to one another. How to build a diversified portfolio. Diversification is a critical component of any investment strategy, including value investing. It is the practice of spreading your investments across a variety of asset classes, industries, and geographies to minimize risk and maximize returns. By investing in a diverse range of assets, you can reduce the impact of any single investment on your portfolio. In value investing, diversification is especially important because it can help mitigate the risk of investing in undervalued companies. Even the most careful analysis can't completely eliminate the risk of a company's stock price dropping or the company facing unforeseen challenges. However, diversification can help balance out these risks and ensure that your overall portfolio is not overly reliant on the success of any one company. To build a diversified portfolio, you should invest in a range of different asset classes, including stocks, bonds, and cash equivalents. Within each asset class, you should consider investing in different industries and geographies. For example, you might invest in stocks of companies in the technology, healthcare, and financial sectors, and also consider investing in stocks of companies in different countries or regions. It's also important to consider the size of the companies you invest in. Investing in both large cap and small cap companies can help balance your portfolio and reduce risk. Finally, you should also consider the level of risk you are comfortable with and invest accordingly. Some investors may be more comfortable with a higher level of risk and invest in more volatile stocks, while others may prefer a more conservative approach. By diversifying your portfolio, you can reduce your overall risk and increase your chances of long-term success as a value investor. Chapter 17. International Value Investing. Value investing is not limited to a particular country or region, but is applicable globally. Investing in international markets can provide diversification benefits and access to companies and industries that may not be available in domestic markets. However, international value investing comes with its own set of challenges, including language barriers, cultural differences, and varying regulatory environments. In this chapter, we will explore the opportunities and challenges of international value investing and provide guidance on how to approach investing in international markets. We will also discuss the importance of conducting thorough due diligence and understanding the risks associated with investing in foreign companies. Opportunities and challenges of international value investing. International value investing involves seeking undervalued companies outside of one's domestic market. It can provide investors with opportunities to diversify their portfolios and potentially access higher growth potential in emerging markets. However, it also comes with unique challenges, such as differences in accounting practices, regulations, and cultural norms. One of the advantages of international value investing is that it allows investors to tap into a broader range of investment opportunities. Emerging markets, for example, may have companies with strong growth potential that are not yet recognized by the market, offering attractive valuations. However, investing in foreign markets also comes with risks. Political instability, economic volatility, and currency fluctuations can all have an impact on the performance of international investments. Additionally, different accounting practices and regulations can make it challenging to compare companies across borders, which can make it difficult to accurately assess their intrinsic value. Overall, international value investing can be a valuable strategy for investors looking to diversify their portfolios and potentially access higher growth potential in emerging markets. However, it's important to carefully consider the risks and challenges associated with investing in foreign markets and to conduct thorough research before making any investment decisions. How to evaluate companies in different markets. When investing internationally, value investors face several challenges and opportunities. On the one hand, investing in foreign markets can provide access to a wider range of companies and industries, as well as exposure to different economic and political environments. This can help to reduce risk and increase potential returns. On the other hand, investing in foreign markets also carries unique risks, such as currency fluctuations, geopolitical risks, and regulatory differences. To evaluate companies in different markets, value investors should use the same principles and techniques that they use for domestic companies. This includes analyzing financial statements, understanding the company's competitive advantage, assessing the quality of the management team, and determining the intrinsic value of the company. However, investors must also be aware of the cultural, legal, and economic differences that exist in different markets. One important consideration when evaluating international companies is currency risk. Investors must consider how fluctuations in exchange rates can affect the value of their investments. For example, if an investor buys a stock in a foreign currency and the currency depreciates against their home currency, the value of their investment will decrease. Another consideration is the regulatory environment. Different countries may have different laws and regulations that affect the operation and profitability of companies. Investors must research and understand these regulations before making investment decisions. Finally, investors must also consider cultural differences when investing internationally. Cultural differences can affect the way companies do business and the way investors are able to interact with them. For example, in some cultures, building personal relationships is crucial to business success, while in others, it may be less important. Overall, international value investing can provide opportunities for diversification and potential higher returns, but it also requires careful research and consideration of the unique risks and challenges that come with investing in different markets. Chapter 18. Investing in Emerging Markets. Investing in emerging markets can be both exciting and challenging. On the one hand, these markets offer high growth potential and diversification opportunities. On the other hand, they can be volatile and unpredictable, with unique risks and complexities. In this chapter, we will explore the potential rewards and risks of investing in emerging markets and discuss strategies for successful investing in these markets. We will also cover key factors to consider when evaluating companies in emerging markets, such as political stability, economic conditions, and cultural differences. By the end of this chapter, you will have a better understanding of how to navigate the unique challenges and opportunities of investing in emerging markets. Opportunities and challenges of investing in emerging markets. Investing in emerging markets can be a high-risk, high-reward proposition. On one hand, emerging markets offer exciting growth prospects and potentially huge returns for investors. On the other hand, these markets are often characterized by political instability, weak institutions, and limited liquidity. As a result, investing in emerging markets requires a deep understanding of the local economy, politics, and culture. One of the main attractions of investing in emerging markets is the potential for high returns. These markets are often growing at a much faster pace than developed markets, and companies in these markets may have more room for growth. However, there are also risks associated with investing in these markets. Political instability, currency risk, and lack of transparency are just a few of the challenges that investors may face. Investors who are interested in investing in emerging markets should also be aware of the unique characteristics of these markets. For example, emerging market companies may have different accounting standards or may be subject to different regulations than companies in developed markets. Additionally, investors may need to consider cultural differences and local business practices when evaluating companies in these markets. Despite the challenges, many value investors believe that emerging markets offer attractive opportunities for long-term growth. By focusing on companies with strong fundamentals and a competitive advantage, investors can potentially build a diversified portfolio of emerging market stocks that can weather the ups and downs of these markets. How to evaluate companies in emerging markets. Investing in emerging markets can be attractive due to their potential for high growth rates and increasing economic development. However, it also involves higher risks due to geopolitical instability, currency volatility, and regulatory uncertainties. When evaluating companies in emerging markets, it is important to consider the same fundamental factors as for companies in developed markets, such as financial performance, competitive advantage, management quality, and valuation. However, there are some additional factors to consider. 1. Political and economic environment. The political and economic stability of the country can have a significant impact on the performance of companies. Investors should consider factors such as government policies, corruption levels, and economic growth prospects. 2. Regulatory framework. Regulations and legal systems can vary widely between emerging markets, and this can have an impact on business operations and investment returns. Investors should be aware of the regulatory environment and any risks associated with it. 3. Infrastructure. Infrastructure development is often a key driver of economic growth in emerging markets and can have a significant impact on the operations of companies. Investors should consider factors such as transportation, communication, and energy infrastructure when evaluating companies. 4. Cultural differences. Cultural differences can also impact business operations in emerging markets, such as differences in business practices, communication styles, and consumer preferences. Investors should be aware of these differences and how they may impact the performance of companies. Overall, investing in emerging markets requires a thorough understanding of the unique risks and opportunities that these markets present. Investors should conduct careful due diligence and seek out expert advice to make informed investment decisions. Chapter 19. Investment Strategies of Famous Value Investors. Throughout the history of the stock market, many successful investors have made fortunes by following the principles of value investing. These investors have often employed unique strategies and approaches to identify undervalued stocks and build a profitable portfolio. In this chapter, we will examine some of the most successful value investors of all time and their investment strategies. By studying the investment strategies of these famous value investors, we can gain valuable insights into the key principles of value investing and learn how to apply them to our own investment decisions. Whether you are a seasoned investor or a beginner, understanding the strategies of successful value investors can help you to make more informed investment decisions and increase your chances of success in the stock market. Investment strategies of famous value investors. Famous value investors have employed different investment strategies to achieve success in the stock market. Some of the most renowned value investors include Warren Buffett, Benjamin Graham, and Seth Klarman. Warren Buffett is perhaps the most famous value investor of all time, known for his long-term buy-and-hold approach to investing. He looks for companies with strong competitive advantages, stable earnings, and consistent dividend payments. Buffett also emphasizes the importance of understanding a company's management team and industry dynamics before making an investment. Benjamin Graham, known as the father of value investing, developed a more quantitative approach to value investing. He developed a framework for analyzing financial statements and used a metric called the price-to-earnings ratio to identify undervalued companies. Graham also emphasized the importance of diversification and buying stocks at a significant discount to their intrinsic value. Seth Klarman, founder of the Baupost Group, has a more opportunistic approach to value investing. He seeks out distressed companies or those experiencing temporary setbacks, buying them at a discount to their intrinsic value. Klarman also emphasizes the importance of risk management and avoiding overpaying for stocks. Other notable value investors include Joel Greenblatt, Howard Marks, and Charlie Munger, each with their unique approach to value investing. By understanding the investment strategies of these successful value investors, investors can gain valuable insights into the principles and techniques of value investing. How to learn from their experiences and apply them to your own investing. Learning from the experiences of famous value investors can be valuable for anyone interested in value investing. By studying their strategies and approaches, we can gain insights into how they evaluate companies, identify value opportunities, and manage their portfolios. One key lesson we can learn from these investors is the importance of patience and discipline in value investing. Many successful value investors have emphasized the need to be patient and to wait for opportunities to present themselves, rather than rushing to make investments based on short-term trends or market movements. Additionally, they stress the importance of discipline in sticking to a well-defined investment strategy and avoiding emotional decisions. Another important lesson we can learn is the value of doing our own research and analysis. Successful value investors tend to be highly independent thinkers and take a long-term view of the companies they invest in. They often conduct extensive research and analysis of financial statements, industry trends, and company management before making investment decisions. Finally, we can learn from these investors the importance of being willing to go against the crowd and take contrarian positions when the market is overly optimistic or pessimistic. Many successful value investors have achieved superior returns by identifying undervalued companies that are out of favor with the market and taking positions that others are unwilling to take. By studying the investment strategies of famous value investors, we can gain a deeper understanding of value investing principles and develop our own approaches to investing that are grounded in sound financial analysis, discipline, and patience. Chapter 20. Value Investing in the Digital Age. In today's digital age, technology has dramatically changed the way we invest and access information about companies. As a value investor, it's important to understand how to navigate this changing landscape and make use of the vast amounts of data and tools available. While the fundamental principles of value investing remain the same, the application of those principles has evolved. In this chapter, we will discuss the ways in which technology has impacted value investing and explore the strategies that successful value investors are using to adapt to the new digital age. We will also discuss the potential pitfalls of relying too heavily on technology and the importance of maintaining a disciplined, long-term approach to investing. Whether you are a seasoned value investor or just starting out, this chapter will provide valuable insights into the ever-changing world of value investing in the digital age. The impact of technology on value investing. Technology has brought a significant impact on almost all aspects of life, and value investing is no exception. The digital age has brought new tools and techniques for analyzing and evaluating companies. Big data and artificial intelligence have enabled investors to process vast amounts of information quickly, identifying patterns and trends that were previously impossible to uncover. The Internet has also made it easier for investors to access information about companies from all around the world. However, technology has also brought new challenges for value investors. The rise of algorithmic trading and the increasing prevalence of passive investing has led to a greater focus on short-term results and a decreased emphasis on long-term value creation. In addition, the speed and volume of information available online has made it more difficult to identify undervalued companies that are hidden from the market. Despite these challenges, value investors can still use technology to their advantage. By using sophisticated analysis tools, value investors can quickly identify undervalued companies and monitor their progress over time. The digital age has also made it easier for investors to connect with other like-minded individuals, share information and ideas, and collaborate on investment opportunities. By adapting to the changes brought about by technology, value investors can continue to identify undervalued companies and create long-term value for their portfolios. How to incorporate technology into your investing strategy. As technology continues to shape the financial world, value investors must adapt to stay competitive. One of the most significant impacts of technology on value investing is the availability of vast amounts of data and information. Investors can access financial statements, news articles, and social media sentiment in real time, providing them with more information to make better informed decisions. To incorporate technology into their investing strategy, value investors can use tools such as stock screeners and algorithmic trading platforms. Stock screeners allow investors to filter through thousands of stocks based on specific criteria such as valuation ratios, profitability, and growth prospects. Algorithmic trading platforms use complex mathematical models to identify trading opportunities and execute trades automatically. Another way to use technology in value investing is by using artificial intelligence, AI, and machine learning algorithms to analyze financial data. AI can identify patterns and correlations that human analysts may overlook, allowing investors to make more accurate predictions about future performance. However, it's crucial to remember that technology should only be a tool to support your investing decisions, not the sole driver of your strategy. Investors must still apply the principles of value investing, such as analyzing a company's financials and evaluating its competitive position to make sound investment decisions. Chapter 21. Ethical Investing. Welcome to Chapter 21, Ethical Investing. In recent years, there has been a growing awareness and interest in investing in companies that align with our personal values and beliefs. Ethical investing, also known as socially responsible investing, SRI, involves considering not only the financial returns of an investment, but also the social and environmental impact of a company's practices. As investors, we have the power to influence change by directing our capital towards companies that are working towards a better future. In this chapter, we will explore the concept of ethical investing, its principles, and how to incorporate it into your investment strategy. The importance of ethical investing. Ethical investing, also known as socially responsible investing, SRI, involves considering not just financial returns, but also the social and environmental impact of a company. The practice has gained popularity in recent years as investors increasingly seek to align their values with their investment decisions. Ethical investing allows investors to support companies that align with their values while also potentially receiving financial returns. It can also put pressure on companies to improve their practices in order to attract investment. However, ethical investing can also present challenges. It can be difficult to accurately assess a company's ethical practices, and what may be considered ethical to one person or group may not be the same for others. Additionally, some investors may need to make trade-offs between financial returns and their ethical values. Overall, ethical investing can be a powerful way to make a positive impact through investing, but it requires careful research and consideration to ensure that both financial and ethical goals are met. How to identify companies that align with your values. Identifying companies that align with your values is a crucial aspect of ethical investing. One way to start is by examining a company's corporate social responsibility, CSR, policies and practices. Look for companies that prioritize ethical behavior, transparency, and sustainability. Consider their impact on the environment, social justice, and human rights. Another approach is to invest in funds that specialize in socially responsible investing, SRI, or environmental, social, and governance, ESG, investing. These funds screen companies based on specific criteria, such as environmental impact, labor practices, or diversity and inclusion policies. They also actively engage with companies to encourage positive change. It's also important to consider the potential trade-offs between ethical values and financial returns. Sometimes, companies that prioritize ethical behavior may not perform as well financially as others. As an ethical investor, you need to decide where to draw the line and how much financial sacrifice you're willing to make to align with your values. Finally, keep in mind that ethical investing is not a one-time decision. Companies can change their policies or practices, and it's essential to stay up to date on their behavior and impact. Regularly reviewing your investments and adjusting your portfolio accordingly can help ensure that you continue to support companies that align with your values. Chapter 22: Environmental, Social, and Governance, ESG, Investing. In recent years, investors have become increasingly interested in investing in companies that prioritize environmental sustainability, social responsibility, and strong governance practices. This approach is known as ESG investing, and it has become a significant trend in the investment world. ESG investing considers a company's impact on the environment, its treatment of employees and stakeholders, and its overall governance structure. The goal is to identify companies that are not only financially profitable, but also make positive contributions to society and the planet. ESG investing has gained traction for several reasons, including the growing awareness of climate change, social justice issues, and the importance of corporate responsibility. Investors who choose to incorporate ESG criteria into their investment strategies can potentially benefit from both financial returns and the satisfaction of supporting companies that align with their values. This chapter will explore the concept of ESG investing, its benefits and challenges, and how to incorporate ESG factors into your investment decision-making process. The concept of ESG investing and its importance in value investing. ESG, environmental, social, and governance investing, is an approach to investing that considers not only the financial performance of a company, but also its impact on the environment, society, and governance practices. This approach to investing has gained popularity in recent years as investors have become more aware of the impact that companies have on the world beyond their financial returns. ESG investing can be seen as a form of value investing because it considers a broader set of factors beyond just financial performance. Companies that have strong ESG practices can have a competitive advantage over companies that do not, which can lead to better financial performance over the long term. Investors who focus on ESG factors may consider a variety of issues, including a company's carbon footprint, employee diversity and inclusion, community engagement, executive compensation, and board diversity. By considering these factors, investors can make more informed decisions about which companies to invest in, with the aim of supporting companies that are making a positive impact on the world while still achieving strong financial returns. In this chapter, we will explore the concept of ESG investing and how it fits into the broader landscape of value investing. We will also discuss how to evaluate a company's ESG practices and incorporate this analysis into your investment decisions. How to evaluate a company's ESG performance. ESG investing has gained popularity in recent years as investors have become more aware of the environmental, social, and governance impacts of companies. ESG factors are considered by investors who seek to invest in companies that are not only financially successful, but also contribute positively to society and the environment. To evaluate a company's ESG performance, investors can start by looking at the company's ESG reports and ratings, which are increasingly being made available by rating agencies and independent research firms. These reports typically provide an overview of the company's performance on a range of ESG metrics, such as greenhouse gas emissions, labor practices, and board diversity. Investors can also look at the company's track record on specific ESG issues that are important to them, such as a company's efforts to reduce waste or its policies on human rights. Another way to evaluate a company's ESG performance is to engage with the company directly. Investors can attend annual general meetings or seek to initiate a dialogue with the company's management to better understand how the company approaches ESG issues and what steps it is taking to improve its performance. It's important to note that there is no one-size-fits-all approach to evaluating ESG performance. Investors must prioritize the issues that matter most to them and develop a framework for evaluating companies based on those issues. Additionally, investors must recognize that ESG performance can vary significantly across industries and regions, so it's essential to have a nuanced understanding of the context in which a company operates. Ultimately, incorporating ESG factors into investment decisions can help investors align their values with their investment portfolios and drive positive change in the companies and industries in which they invest. Chapter 23: Value Investing versus Growth Investing. Value investing and growth investing are two approaches to investing that have been debated for decades. Both approaches have their own strengths and weaknesses, and each can be suitable for different types of investors. In this chapter, we will explore the differences between value investing and growth investing, and the pros and cons of each approach. While value investors focus on finding undervalued companies trading at a discount to their intrinsic value, growth investors focus on companies that are expected to experience high growth rates in the future. Value investors typically look for companies with stable earnings, low price-to-earnings ratios, and strong balance sheets. On the other hand, growth investors are willing to pay a premium for companies that have a high potential for growth, even if their current earnings may be low or negative. There is no right or wrong approach to investing, and both value and growth investing can be successful. The key is to find an approach that aligns with your investment goals and risk tolerance. In the following sections, we will dive deeper into the differences between value and growth investing and how to decide which approach is best for you. The differences between value investing and growth investing. Value investing and growth investing are two approaches to investing that differ in their focus and methodology. Value investors seek to identify companies that are trading at a discount to their intrinsic value, while growth investors focus on companies with strong growth potential, even if they are trading at a premium. Value investing is often associated with a focus on financial metrics such as earnings, dividends, and book value, while growth investing is associated with a focus on forward-looking metrics such as revenue growth and earnings growth. Value investors typically look for companies with a history of stable earnings and cash flows, while growth investors may be willing to invest in companies that are not yet profitable but have the potential for future growth. Another key difference between the two approaches is their investment horizon. Value investors tend to have a longer-term outlook, seeking to buy stocks that they believe are undervalued and hold them for several years, while growth investors may be more focused on short-term price movements and may be more likely to trade frequently. Ultimately, both value investing and growth investing can be successful approaches to investing, and investors may choose to use a combination of the two in their portfolios. The key is to understand the differences between the two approaches and to select investments that align with your investment goals and risk tolerance. The pros and cons of each approach. Value investing and growth investing are two distinct approaches to investing in the stock market. Value investors focus on finding undervalued companies with strong fundamentals, such as a low price-to-earnings ratio or high dividend yield. On the other hand, growth investors focus on companies with high potential for future growth, even if they are currently trading at a premium valuation. One of the advantages of value investing is that it can be a more conservative approach to investing. By investing in companies that are undervalued, there is less risk of overpaying for a stock and being subject to a significant loss if the company's stock price drops. Value investors also tend to focus on companies with strong balance sheets and stable cash flows, which can provide a measure of safety in uncertain economic times. Growth investing, on the other hand, can offer the potential for higher returns in the long term. By investing in companies with high growth potential, investors can benefit from the compounding effect of growth over time. Growth investors also tend to be more willing to invest in companies that may not have a strong track record of earnings, but have a strong vision for the future. However, growth investing also comes with higher risk. Companies with high growth potential are often subject to greater volatility, as their stock prices can be influenced by factors such as news about their growth prospects or changes in industry trends. Additionally, growth stocks often trade at a premium valuation, which means that investors may be paying a higher price for the potential future growth of the company. Ultimately, the choice between value investing and growth investing depends on an investor's individual preferences and risk tolerance. Some investors may choose to use a combination of both approaches in their portfolio, while others may prefer to focus on one or the other. It is important for investors to carefully evaluate the pros and cons of each approach and consider their own investment goals and risk tolerance before making investment decisions. Chapter 24. Value Investing in Real Estate. Real estate investing is a popular way to build wealth and generate income. Many successful investors have used real estate as a means of creating long-term financial security. Value investing, which is a strategy that involves identifying undervalued assets and investing in them for the long term, can be applied to real estate investing as well. In this chapter, we will explore how value investing principles can be applied to real estate investing and how investors can take advantage of opportunities in the real estate market to generate long-term returns. We will also discuss the unique characteristics of real estate as an asset class and the risks and rewards associated with real estate investing. Whether you are a seasoned real estate investor or are just starting out, this chapter will provide you with valuable insights and strategies for successful value investing in real estate. The principles of value investing in real estate. Real estate has been a popular investment for centuries, and value investing principles can be applied to it. Value investing in real estate involves finding undervalued properties and buying them with the intention of holding them for the long term until they increase in value. One key principle of value investing in real estate is to focus on properties with strong fundamentals. This includes properties in desirable locations, with strong demand from renters or buyers, and with positive cash flow potential. Another important principle is to look for properties that are priced below their intrinsic value. This can involve identifying properties that are distressed, such as those in foreclosure or in need of repairs, and purchasing them at a discount. It can also involve analyzing market conditions to identify properties that are undervalued due to temporary factors, such as an oversupply of housing or a downturn in the local economy. Additionally, value investors in real estate often prioritize long-term appreciation over short-term gains. This means that they are willing to hold on to properties for an extended period of time, even if their value does not immediately increase. This approach can be particularly effective in real estate, as properties tend to appreciate over the long term due to factors such as population growth and inflation. Overall, value investing principles can be a powerful tool for investors in the real estate market. By focusing on undervalued properties with strong fundamentals and a long-term appreciation potential, investors can build a portfolio of properties that generate stable returns and appreciate in value over time. How to identify undervalued properties and assess their potential for long-term growth. When it comes to real estate investing, value investing involves buying properties that are undervalued or have potential for long-term growth. There are several principles of value investing in real estate that investors should consider when evaluating properties. First, investors should focus on the intrinsic value of the property, which is the value of the property based on its underlying characteristics and potential for income generation. This involves analyzing factors such as location, physical condition, rental income potential, and future development plans. Second, investors should look for properties that are priced below their intrinsic value, also known as a margin of safety. This provides a cushion in case of unexpected market fluctuations or other risks. Third, investors should consider the long-term potential for growth in the property's value, rather than short-term fluctuations. This involves analyzing trends in the local real estate market and the broader economy, as well as potential future development plans for the surrounding area. Finally, investors should take a disciplined approach to buying and selling real estate, focusing on the fundamentals of the property rather than emotions or market hype. This involves developing a clear investment strategy and sticking to it, while remaining flexible and adaptable as market conditions change. Overall, value investing in real estate can be a profitable and rewarding strategy for investors who are willing to do their homework and take a long-term approach to building their portfolio. Chapter 25. Value investing in commodities. Commodities are tangible goods that can be bought and sold, such as precious metals, agricultural products, and energy sources. These assets are essential to the global economy and play a crucial role in various industries, including manufacturing, transportation, and construction. Investing in commodities can be an excellent way to diversify your portfolio and protect against inflation. However, it requires a unique set of skills and knowledge to navigate the volatile and complex commodity markets successfully. In this chapter, we will discuss the principles of value investing in commodities and explore the challenges and opportunities in this asset class. We will also provide practical tips on how to identify undervalued commodities and build a profitable investment strategy. The principles of value investing in commodities. Value investing in commodities involves identifying undervalued commodity assets and buying them at a discount to their intrinsic value. Commodities are raw materials that are used to produce goods and services, such as oil, natural gas, precious metals, and agricultural products. The prices of these commodities can be affected by supply and demand factors, as well as geopolitical and macroeconomic events. In value investing, the focus is on the long-term potential of the commodity rather than its short-term price fluctuations. This requires a thorough analysis of the commodity's fundamentals, such as its supply and demand dynamics, production costs, and market trends. Additionally, it involves identifying market inefficiencies and taking advantage of opportunities to purchase commodities at a discount. Value investing in commodities can provide diversification benefits to an investor's portfolio, as well as potential inflation protection. However, it also involves significant risks, such as volatility, geopolitical risks, and environmental risks. How to identify undervalued commodities and assess their potential for long-term growth. In value investing, the goal is to identify assets that are undervalued by the market, and commodities are no exception. While many investors tend to focus on stocks and bonds, commodities can also present an opportunity for value investing. Commodities are physical goods that are traded on exchanges, such as gold, oil, and agricultural products. The prices of these goods are determined by supply and demand, as well as other factors such as geopolitical events and economic conditions. To identify undervalued commodities, value investors must first understand the supply and demand dynamics of the market. This involves analyzing factors such as production levels, global demand, and geopolitical risks that may impact supply. For example, if a commodity is experiencing a supply shortage due to a natural disaster or political unrest in the producing country, its price may rise in response to the reduced supply. Conversely, if there is an oversupply of a commodity, its price may decline as there are fewer buyers than sellers. In addition to supply and demand dynamics, value investors may also consider the long-term potential for growth in a commodity. For instance, if a commodity is essential for a particular industry or technology, its demand may increase over time, leading to higher prices. To assess the potential for long-term growth, Value investors may analyze macroeconomic trends and industry developments to understand how the demand for a commodity is likely to evolve over time. Value investors may also consider the cost of production for a commodity when evaluating its potential for long-term growth. If the cost of production is higher than the market price, producers may reduce production, leading to a potential supply shortage in the future. In summary, value investing in commodities involves identifying undervalued assets by analyzing supply and demand dynamics, assessing long-term growth potential, and considering production costs. By applying the principles of value investing to commodities, investors can potentially identify opportunities for long-term growth and generate returns that outperform the market. Chapter 26. Value Investing in Alternative Investments. While stocks, bonds, and real estate are commonly known as investment options, there are several other alternative investment opportunities that investors can consider. Alternative investments offer a different approach to investing and can provide diversification to a portfolio. However, these investments can also be more complex and require a different skill set to evaluate. In this chapter, we will explore the principles of value investing in alternative investments and discuss how they can be incorporated into a diversified investment strategy. The principles of value investing in alternative investments, such as hedge funds, private equity, and venture capital. Alternative investments refer to any investment other than traditional stocks, bonds, and cash. Alternative investments include hedge funds, private equity, venture capital, real estate, commodities, and other asset classes. These types of investments are generally less liquid and more complex than traditional investments, but they also offer the potential for higher returns. Value investing principles can be applied to alternative investments just as they can to traditional investments. For example, when investing in a hedge fund or private equity, it is important to identify managers with a proven track record of generating consistent returns and who are aligned with their investors' interests. It is also important to understand the fees and expenses associated with these types of investments. When investing in real estate, the principles of value investing can be applied by identifying undervalued properties and assessing their potential for long-term growth. In addition, it is important to evaluate the local real estate market and to understand the risks associated with owning and managing property. Venture capital investing involves providing capital to startup companies in exchange for an ownership stake. To apply value investing principles to venture capital, investors must identify companies with a strong management team, a clear strategy for growth, and a large potential market. It is also important to understand the risks associated with early-stage investing and to have a long-term investment horizon. Overall, the principles of value investing can be applied to a wide range of alternative investments, but it is important to understand the unique characteristics and risks of each asset class before investing. How to identify undervalued opportunities and assess their potential for long-term growth. When it comes to alternative investments, such as hedge funds, private equity, and venture capital, the principles of value investing still apply. However, evaluating these opportunities can be more challenging, as there is often limited information available and the risks can be higher than with traditional investments. To identify undervalued opportunities in alternative investments, it is important to thoroughly research the management team, their track record, and their investment strategy. Look for managers with a proven ability to generate returns and a history of making prudent investment decisions. It is also important to carefully evaluate the investment thesis and assess the potential for long-term growth. Consider the market opportunity, the competitive landscape, and the potential risks and uncertainties. Look for investments that have a clear path to value creation and a potential exit strategy that aligns with your investment goals. Additionally, be mindful of the fees and expenses associated with alternative investments. Many alternative investments charge high fees and may require a significant investment minimum, so it is important to carefully evaluate the potential returns and weigh them against the costs. Overall, Value investing principles can be applied to alternative investments, but it is important to conduct thorough due diligence and carefully evaluate the potential risks and returns before making any investment decisions. Chapter 27. Investing in a Crisis. Investing during a crisis can be daunting, as the uncertainty and volatility of the market can create a sense of fear and panic among investors. However, crises can also present unique opportunities for value investors to identify undervalued assets and take advantage of market dislocations. In this chapter, we will explore the principles of value investing in times of crisis, including the importance of maintaining a long-term perspective, focusing on quality assets, and being prepared to act decisively when opportunities arise. We will also discuss some of the common mistakes that investors make during a crisis and provide guidance on how to avoid them. By the end of this chapter, you will have a better understanding of how to navigate the challenges and capitalize on the opportunities presented by a crisis. How value investing principles can be applied during times of economic crisis. Value investing principles can be particularly useful during times of economic crisis when there is a great deal of uncertainty and volatility in the markets. In such situations, many investors may be tempted to panic and sell their investments, leading to a sharp decline in prices. However, value investors can take advantage of these opportunities by focusing on the underlying fundamentals of a company and seeking out undervalued stocks that have been oversold due to market panic. During a crisis, value investors should pay particular attention to a company's balance sheet and cash flow, as well as its competitive position within the industry. They should look for companies with strong financials that are well positioned to weather the storm, and avoid those that are heavily indebted or have weak cash flow. They should also seek out companies that have a competitive advantage or unique value proposition, as these are the types of companies that are more likely to emerge stronger from a crisis. Another key strategy during a crisis is to take a long-term perspective and focus on the potential for future growth. While it may be tempting to focus solely on short-term gains during a crisis, value investors recognize that the best investments are those that offer both short-term value and long-term growth potential. By focusing on companies with strong fundamentals and a clear path to growth, investors can position themselves for success in the years to come, even as they weather the current crisis. Overall, the principles of value investing can be particularly useful during times of economic crisis, as they offer a disciplined approach to investing that can help investors navigate uncertainty and volatility in the markets. By focusing on the underlying fundamentals of a company and seeking out undervalued opportunities with long-term growth potential, investors can position themselves for success even in the most challenging of times. How to identify undervalued opportunities during a crisis and assess their potential for long-term growth. During a crisis, many companies may face significant challenges, but there may also be opportunities for value investors to identify undervalued assets. One key principle of value investing during a crisis is to maintain a long-term perspective and avoid short-term thinking. Panic selling and market volatility may create temporary dips in the prices of otherwise sound companies, presenting opportunities for value investors to buy in at a discount. To identify undervalued opportunities during a crisis, it is important to conduct thorough research and analysis of potential investments. This may involve analyzing a company's financial statements, assessing its competitive position in the market, and evaluating the strength of its management team. Additionally, value investors may want to consider macroeconomic factors such as changes in consumer behavior or shifts in industry trends that could impact the performance of certain companies or industries. It is also important to remember that not all companies will survive a crisis, so it is essential to have a diversified portfolio that includes a mix of established, financially stable companies and more speculative investments with higher potential for growth. Value investors should be patient and willing to hold on to their investments for the long term, even if there is short-term volatility. Overall, value investing during a crisis requires discipline, research, and a willingness to take a contrarian approach to investing. By identifying undervalued opportunities and maintaining a long-term perspective, value investors can position themselves for long-term success even in uncertain times. Chapter 28: The Future of Value Investing. Chapter 28 delves into the future of value investing and how the practice is expected to evolve in the coming years. In recent times, value investing has faced criticism for its underperformance compared to growth investing, but many believe that the principles of value investing will remain relevant in the future. The chapter will explore how technological advancements, changing market dynamics, and global events may shape the future of value investing. It will also discuss how investors can adapt to these changes to continue to achieve long-term success. The future of value investing and how it may evolve in response to changes in the global economy. Value investing has been a time-tested investment strategy for decades, but it's not immune to change. As the global economy continues to evolve, so too must value investing. One of the biggest challenges facing value investors today is the low interest rate environment, which has resulted in high valuations for many companies. This has made it more difficult to find undervalued opportunities and has prompted some investors to question the efficacy of value investing as a long-term strategy. However, despite these challenges, there are reasons to be optimistic about the future of value investing. First and foremost, the principles of value investing are rooted in fundamental analysis, which is unlikely to go out of style anytime soon. In addition, as the global economy becomes increasingly complex and unpredictable, there may be a renewed appreciation for the simple, straightforward approach of value investing. Another factor to consider is the rise of new technologies, such as artificial intelligence and machine learning, which may provide value investors with new tools to identify undervalued opportunities. However, it's important to note that these technologies are still in their early stages and may take time to fully mature and be integrated into the value investing process. Finally, there is the ongoing shift towards sustainable and responsible investing, which may create new opportunities for value investors who are able to identify companies that are both undervalued and aligned with their values. Overall, the future of value investing is uncertain, but there are reasons to believe that the principles of value investing will continue to be relevant for years to come. As always, the key to successful investing is to stay informed, stay patient, and stay disciplined in your approach. How investors can adapt to these changes and continue to apply value investing principles. As the global economy continues to evolve, value investing principles may need to adapt as well. Some investors may argue that the traditional principles of value investing may not work as well in a rapidly changing technological landscape, while others believe that these principles remain just as relevant as they ever were. One way that investors can adapt to changes in the global economy is by staying up to date on technological advancements and incorporating new data sources and analysis techniques into their investing strategies. For example, investors can use machine learning algorithms to analyze vast amounts of data and identify undervalued opportunities in a more efficient manner. Another way to adapt to changes in the global economy is to broaden the definition of value beyond the traditional metrics of price-to-earnings ratio and book value. Investors can incorporate environmental, social, and governance (ESG) factors into their analysis to identify companies that are not only undervalued but also sustainable and responsible. Ultimately, the future of value investing will depend on how investors adapt to changes in the global economy and incorporate new technologies and analysis techniques into their strategies. By staying true to the core principles of value investing while also embracing new developments, investors can continue to achieve long-term success. Chapter 29: Building Your Value Investing Portfolio. Now that you have a solid understanding of the principles and strategies of value investing, it's time to put that knowledge into action and start building your own value investing portfolio. This chapter will provide practical guidance on how to construct a diversified portfolio of undervalued assets that align with your investment goals and risk tolerance. Investing in undervalued assets requires a long-term perspective and patience. It's important to resist the temptation to chase short-term gains or to follow the latest investment trends. Instead, focus on identifying high-quality assets that have been overlooked or undervalued by the market and hold on to them for the long haul. This chapter will cover the key steps to building a successful value investing portfolio, including setting investment goals, identifying undervalued assets, managing risk, and monitoring and adjusting your portfolio over time. By following these steps, you can create a portfolio that generates strong returns while minimizing risk and that aligns with your values and investment philosophy. How to build a value investing portfolio that aligns with your goals and risk tolerance. Building a value investing portfolio requires careful consideration of various factors, including your investment goals, risk tolerance, and time horizon. One of the key principles of value investing is to seek out undervalued opportunities that have the potential for long-term growth, and this applies not just to individual stocks, but to the portfolio as a whole. To build a value investing portfolio, you should begin by identifying your investment goals and risk tolerance. This will help you determine the appropriate asset allocation and the types of investments that best suit your needs. For example, if you have a long time horizon and a higher risk tolerance, you may choose to allocate a larger portion of your portfolio to stocks. While if you have a shorter time horizon or a lower risk tolerance, you may choose to allocate more to fixed income investments. Once you have determined your asset allocation, you can begin selecting individual investments. The key is to look for undervalued opportunities that have the potential for long-term growth. This may involve analyzing company financials, industry trends, and macroeconomic factors to identify stocks that are trading at a discount to their intrinsic value. It's important to maintain a diversified portfolio that includes a mix of different types of investments, such as stocks, bonds, and real estate, to help manage risk and reduce the impact of any single investment on your overall portfolio. Additionally, regular monitoring and rebalancing of your portfolio can help ensure that it remains aligned with your investment goals and risk tolerance over time. Overall, building a value investing portfolio requires careful consideration of various factors, including your investment goals, risk tolerance, and time horizon, as well as a disciplined approach to identifying undervalued opportunities and maintaining a diversified portfolio. How to monitor and adjust your portfolio over time. Monitoring and adjusting your value investing portfolio is a critical part of the investment process. Even the most well-crafted portfolio will need to be reviewed and updated periodically to reflect changes in the market and your personal goals and risk tolerance. Here are some key steps to consider. 1. Regularly review your portfolio performance. Set up a schedule for monitoring and reviewing your portfolio, whether it's quarterly, semi-annually, or annually. Evaluate your portfolio's performance against your goals and benchmarks and identify any areas that may need adjustment. 2. Rebalance your portfolio. Rebalancing involves adjusting the weights of your investments in your portfolio to maintain your desired asset allocation. For example, if one asset class has performed well and now represents a larger percentage of your portfolio than you intended, you may need to sell some of those investments and reinvest in other asset classes to bring your portfolio back into balance. 3. Consider tax implications. As you adjust your portfolio, be mindful of the potential tax implications of buying and selling investments. Consult with a tax professional to develop a tax-efficient strategy. 4. Stay disciplined. Stick to your investment strategy and resist the urge to make impulsive decisions based on short-term market movements. Value investing is a long-term strategy, and it's important to stay disciplined and patient. 5. Continuously learn and adapt. As you gain experience and insights into value investing, be open to learning and adapting your approach. Keep up with developments in the market, and the latest investment research, and use this information to refine your investment strategy over time. Building a successful value investing portfolio requires careful planning, ongoing monitoring, and a disciplined approach to investing. By following these steps, you can build a portfolio that aligns with your goals and risk tolerance and provides a solid foundation for long-term investment success. Conclusion. As we come to the end of this book, it is important to reflect on the principles of value investing and how they can help investors achieve their financial goals. Value investing has a long history of success, with many legendary investors using this approach to build their wealth and achieve financial freedom. Throughout this book, we have explored the key principles of value investing, including how to identify undervalued companies, assess their potential for long-term growth, and incorporate factors such as ESG and ethical considerations into our investment decisions. We have also examined how value investing can be applied to various asset classes, such as real estate, commodities, and alternative investments. While the world of investing is constantly changing, the principles of value investing remain as relevant today as ever before. By focusing on the underlying value of a company or asset and investing for the long term, investors can build a solid financial foundation and achieve their financial goals. In the following chapter, we will summarize the key takeaways from this book and provide some final thoughts on how investors can apply the principles of value investing to their own portfolios. Value investing is an investment strategy that involves identifying undervalued securities in the market and investing in them with the goal of achieving long-term growth. Key principles of value investing include analyzing a company's financial statements to determine its intrinsic value, looking for companies with a margin of safety, and investing in companies with a sustainable competitive advantage. Value investors also place a high importance on management quality and consider the economic and market conditions while making investment decisions. While value investing has been a popular strategy for decades, it is not without its challenges. It requires discipline and patience, as well as the ability to withstand short-term fluctuations in the market. However, the potential rewards can be significant for those who are able to identify undervalued opportunities and hold on to them for the long term. In addition to traditional stock investments, value investing can also be applied to other asset classes such as real estate, commodities, and alternative investments. Moreover, ethical and ESG investing are emerging trends that value investors can incorporate into their strategy. Ultimately, successful value investing requires a thorough understanding of the principles and the ability to apply them consistently over time. By staying disciplined, patient, and focused on the long term, investors can build a portfolio that aligns with their goals and risk tolerance while achieving sustainable growth. Value investing is a strategy that has been used successfully by many investors to achieve long-term success in the stock market. By focusing on buying undervalued stocks and holding them for the long term, value investors can benefit from market inefficiencies and the tendency for stock prices to eventually reflect a company's true value. One of the key benefits of value investing is its emphasis on the fundamentals of a company, such as its financial statements, competitive position, and management team. By carefully analyzing these factors, value investors can identify companies with strong potential for long-term growth and profitability, even if their current stock price may not reflect this value. Another benefit of value investing is its emphasis on patience and discipline. Unlike some other investment strategies that may rely on short-term trading or speculation, value investing requires a long-term perspective and the willingness to hold on to a stock through short-term volatility and market fluctuations. Overall, value investing can provide investors with a solid framework for building a diversified and profitable stock portfolio. By sticking to the principles of value investing, investors can avoid common pitfalls and position themselves for long-term success in the stock market.